Okay, family, this is the master trader himself back again with another interesting video. This is a wonderful day, a precious day. We're going to learn something that is beautiful, wonderful sun out there for us to embrace life and also to move forward in our trading career. So basically today we are talking about market imbalance. Guys, this is one of the most important topics as well. If you grasp this information in this particular topic, trust me, you will be one of the most profitable traders you have ever come across yourself in your life. So that's the thing. So today is a wonderful day. Let's get started. The big question as always is, what is market imbalance? As always, so market imbalance zones are areas where the market changes direction rapidly after hitting a certain area. So these are nothing but areas where the market does what? Changes rapidly in direction after hitting those areas. So these are areas in the market, in the financial market. Whenever the market reaches in those zones, the market changes direction rapidly at a faster rate. So your main focus in this topic is that you need to know how to spot those particular areas where the market changes direction so that you can trade them. Okay, where can they be found? I want you to take this is a very important thing. These are the main criteria to why you should take the trade, how you can know these same market imbalance areas of support and resistance. The moment you see an area of support and resistance, just know that there is more likely to be an area of imbalance that is going to occur. I will explain later concerning this area of support and resistance. Write that down. Areas of support and resistance, I repeat again, areas of support and resistance appears to areas of supply and demand. So same as areas of support and resistance. Areas with order blocks, same applies with support and resistance. This is just one and the same thing. So the most important thing that we should take note of is that these are usually associated with the support and resistance areas. They're usually associated with supply and demand areas. They're usually associated with order blocks areas. So that's the thing. How can we identify imbalance? Identify areas of support and resistance, supply and demand, order blocks. That's the first thing. Look at how price reversed from these zones. Look at how price reacted when it reached the areas of what? Your support and resistance. Let us imagine below to illustrate how we find these areas on the charts. So for example, I have a chart here. So guys, I have a chart here. This was from, what was this? This was Crash 500, I think so. Yes, this was 1 hour time frame. I can remember this straight. So what happened is that the market was moving like that, but it reached this zone, and again the market moved down, and it reached again this same zone, making a double what? Top, which is what? A resistance. So we draw our resistance from above there. This is our resistance. But when the market reached this zone, the market rapidly moved down in a downtrend. Rapidly. We have not seen any change of any color of the candle from black to orange. No, we are seeing black candles throughout. For the next how many? For the last how many hours? 1, 2, 3, 4. For the last 4 hours, the market has shown to have a rapid moved downwardly. When we see this rapid move in the market, plus our support and resistance zone, this should trigger in our mind that somewhere, somehow here, there is an imbalance that should be filled. you'll get the concept very soon. There will be an imbalance that will get filled. The moment the market comes back to fill that imbalance, guys, we go with the market as it fills the imbalance. So price was initially moving higher and then hit a resistance zone. From there, we can see 4 consecutive bearish candles representing strong selling at the area of resistance. So as price was moving in this direction, with the moment it reached our area of resistance, we saw 4 consecutive bearish candles being formed rapidly, which simply means the market is moving at a rapid state. Okay, I have marked the candle with numbers to help you understand. Let us see below. So I've marked these candles to make you understand what I'm talking about. This is my first candle, this is my second, this is my third, this is my fourth. These 4 candles have rapidly moved. You see, right? We have rapidly moved just after an area of what? Of resistance above here. Okay, when we look at the candles marked with a number, candle number 2 is usually found to be the biggest in size. So when you see this candle number 2, it should be the biggest in size among these candles. It should be the biggest in size. So that's a thing. Candle number 2 shows that sellers were in charge with not many buyers interested to jump in and stop the price from falling below. Sometimes, depending on the market that you are trading, you must know the market that you are trading. If you don't trade boom and crash, in most cases it will be the third one that will be larger than each and every candle, so you still use the same concept that I'm teaching you. But in this case, when it comes to boom and crash, you use the second candle. So that's a thing. But I want you to understand this point. It shows that sellers were in power when this candle was being formed. It was selling down rapidly. Always ensure that the candle number 2 closes below than the higher of the candle number 3. Ensure that its closing, its opening is here, right? Because it's a bearish candle, so its closing is down here. Always ensure that its closing is what, guys? Is higher than the opening of the third candle. The opening of the third candle is there. I hope that is understood. Okay, how to mark imbalance zones. So that's a very important thing that we have to understand. How can we mark this out? So mark the low of the candle number 1. Mark the low of the candle number 1. So you mark this low of the candle number 1. Okay, mark the high of the candle number 3. You mark the high of the candle number 3. The zone between the market line is the imbalance zone. Let us see on the chart. So you see, you mark the low, this candle, this is the low point of candle number 1. You mark it. The highest point, or the highest point of candle number 3, you also mark it. It will form a zone. This is what we are calling imbalance zone. So you mark this zone, you shade this zone throughout your chart, going this side, going this side. You mark your zone. Yes. How do you trade based on imbalance? Now, how can we trade based on these markings? How can we trade? Wait for the price to come back to the imbalance zone. So you wait for this price to come back here. You wait for this price to come back here in this zone. Okay. Sell once price touches the zone. Make sure you sell when price touches the zone. You go with the market down. Okay. You can put pending orders too. You can put the pending orders. If you're not around with the market to actually come back, you can put pending orders. Let us see what happens once price retests the imbalance zone. So this is what happened, guys. I traded this is what happened. Like we said, the market moved like that, reached the area of what? The area of the support and resistance. Then the market moved down. After moving down, it didn't touch, so we can't enter if it doesn't touch the zone that we have made, which we actually made using the top part of the third candle and the bottom part of the first candle, this zone here. The moment the market came here, guys, for me in most cases on boom and crash, for me, I even wait for a retest, for a confirmation retest. That's when I enter the market eventually. So for my entry position, you find that sometimes I may even miss the second entry position. We talked in Imbalance that there is a first entry position where you enter from here. The second one, you enter 50% or 50% of the zone. Then your stop loss will just be slightly above the zone, right? That's what we said. So even the same entry, you can do the same stuff. But me, I usually wait for a confirmation of a retest, then I enter from here. If at all the candle feels some messy to come and put me in at the 50 percent here, it will be my second entry position. Then I will have my stop loss over there. So whenever it touches there, in most cases it will actually go down. Yes, so you are going to trade this movement, you see, right? You're going to trade from here, and this is 1 hour. So you can be in the market for how many hours? If you entered from here, 1 2 3 4 5 6 7 8 9 10 hours. If you want, you can come out. This, it can be a take profit, because we are seeing a bench of some sort here. It can be a take profit 1 if you want, or yeah, it can be a take profit 1 if you want, or you will eventually do what? You eventually wait, guys. It will, yeah, it went way up to that point. If you know IFC candles, you actually know what we're dealing with. You can actually just indicate an IFC candle from there, then you make more entries from there. Then the market goes down again. It went way down there, guys. It went way down here. So in most cases, if you enter from here, the market is most likely that it can go there. Just imagine from 1 2 3 4 5 6 7 8 9 10 11 12 13 14 15 16 17 18 19 20 21 22 23 24. So you can be in a market for a day, guys. You can be in the market for a complete day. So that's the thing. Setting pending orders for imbalance zones. You can set the first pending order just at the high of the the candle number 3, like I was explaining. You can set your pending order from here. Another pending order should be placed on the middle of the zone. Another pending order, I've explained this, should be placed on the middle of the zone. But in my case, I missed this trade. I remember I missed this trade by 5 pips. My second entry, I only entered my first entry, but my second entry was missed by 5 pips. So if you want to be area in the market without waiting for every test confirmation, you can enter from there. So that's the thing. Okay, you can measure the midpoint by using Fibonacci 2. Yeah, by just using Fibonacci 2, you can measure your 50%. Okay, let's see these levels. You see what happened, right? My first order, I make sure that when I'm marking up the charts, they are clean, guys. You see, they are clean, very clean. You can even, you enter from there, boom. You see, right? You enter from here, boom. There, that would be my second entry position. It was just missed by 5 pips there. It was just missed by 5 pips, but I entered my first entries. But my second entries were just missed by 5 pips. My stop loss was just like above there. Then I went the market way down there. So setting pending orders. The green line in the middle point of the zone, and it is our first entry position. I've already explained that. We can see our price change direction once it started. It tested the zone. Yes, we have seen how the market changed direction, a rapidly changing direction after touching the zone. Our first entry was triggered. Our second entry was missed by 5 pips. I've already explained this. I missed this by 5 pips. I also included in this PowerPoint. Yeah. Which time frame should I use, or which time frames are best when it comes to imbalance? We generally stick to the higher time frames when looking at imbalance in prices. The 1 hour time frame or higher is the best, as these time frames provide the best range. If you use a higher time frame imbalance, it may only be few pips, just is not overall helpful. Yes, when you use low time frame, it will just be few pips. You just not spend much time in the market. That will not be profitable at all. Maybe if you're a scalper, yes, you can scalp using the same methods, but if you want to really milk from the financial market, you go for higher time frames. One thing to note is that imbalance is more of an additional confluence and the reference point of where price may revisit. So mainly, you don't really 100% stick only to imbalance. Make sure that you have other confirmations, yes, like a trend line, like something that is really supporting your imbalance. But in this case, this was a sure one. In this case, this one is a sure one. But sometimes you might draw a trend line from here. You find that it to touch that point, that will be a retest on the trend line. So it's a for confirmation of going down. And again, you find that your trend line also touch there. That would be just a confirmation of the market is still going down. Yes, so that's a thing. Ensure you also use other confirmations if possible. I've already explained that. And thank you so much. And what do we do at Trading Billions Academy? We go to the charts, because you don't know if at all you have not read, seen, watched any video, practiced, or done anything concerning that topic. You don't know anything. So we have now learned, we have seen, and we need to go and practice it and see it on real charts. Like for example, this was a real chart. Yes, I traded this. You can go into the market, start spotting these zones, repeat the video, watch it over and over again until it sinks in you. So thank you so much, love you so much, and see you in the next video. The Master Trader, love you.